another session of the subject Management of Insurance Services. In this block 4, we will deal with the different managerial issues relating to insurance sector. This unit 12, we will focus on the corporate governance of insurance sector. In the past 3 blocks and in different other units which we have understood previously, we have known about the insurance sector as a whole and how is it contributing to the Indian economy. We have also understood the different types of insurance schemes which are available, broadly categorizing as life insurance policies and general insurance policies. And also we have understood the different specialized insurance schemes which are available, like health insurance, medical insurance, etc. Today, we will focus on few highlights of the governance, the control pattern, how is it actually regulated, so that the entire insurance sector is operated in a proper discipline. In this session, we will go through the concept of corporate governance. What does the concept means? We will understand the guidelines based on which the principle of corporate governance lies, the corporate governance which is relating to insurance sector, and few highlights of the regulatory authorities guidelines, IRDAI guidelines on the corporate governance, and finally we will understand the governance structure. Before understanding the governance of insurance industry as a whole, let us first understand the term, what does governance mean? So every organization, in order to run its entire operation smoothly, governance plays a vital role. So that is why an organization structure is always there, so that proper dissemination of the duties are there, proper monitoring of the duties by the authorities are there, and control pattern is also scheduled so that finally the ultimate goal of the organization is achieved. So that is why governance plays a very vital role in realizing the objective for which any organization exists. So governance refers to the overall system through which an organization is directed, monitored, and controlled by its leadership and governing bodies. Like the Indian stock market, the Indian stock market is governed by the overall guideline is by the SEBI, Security Exchange Board of India. Now, all the rules and regulations, the guidelines which are laid down by SEBI has to be strictly adhered by the capital market. So similarly, governance in case of insurance sector also, there are certain rules and guidelines based on which the entire insurance sector has to operate. So now governance provides a structured framework of rules, policies, processes, and ethical standards that guides how decisions are made and implemented. As I just discussed, that every organization should have a system of different functional areas based on which the organization will be functioning. So that is known as governance. Effective governance includes key elements such as risk management, regulatory compliances, transparency, accountability, and responsible leadership. We will go to these different aspects one by one in the slides later. It ensures that organizational decisions are taken in fair, transparent, and a well-informed manner. And it reduces the chances of misuse of power or resources. So governance also creates clear roles and responsibilities for management, the board, and other key functions. Like in an organization, there are board of directors, there are persons who are below the board of directors who are operating as functional heads of different other departments, and there will be few operational managers who are functioning just below the heads. So now the governance has prescribed rules, regulations, and policies based on which these different authorities have to function so that ultimately smooth operation takes place. Hence, the ultimate objective of governance is to protect and balance the interest of all the stakeholders. Stakeholders are the persons who are directly or indirectly involved with the organization, which includes the shareholders, the customers, the employees, regulators, and the society at large. So that is why having a governance or the system or procedure to work is very much important within an organization. Now let us move on to what is corporate governance. Corporate means a company or industry as a whole. So when we talk about corporate governance is a system by which companies are directed and managed. So there are acts, and within that acts, there is framework which is given that a company should have a board of directors. The company should have officials who are appointed as head of different departments, and there has to be different laid down policies and procedures on system within which those heads and monitoring authorities need to operate. That is nothing but a corporate governance. So the board of director is responsible for guiding strategies and monitoring the performance. The top level management in an organization is the board of directors, who are responsible for preparing the strategic decision for a particular period of time. And it's not only making or planning a strategic decision, a strategic planning, but they are also there to monitor these planning which they have made at regular intervals. Shareholders appoint directors and auditors to ensure proper management. So if we talk about a company, the shareholders of a company, they are the owners of the company, they are appointing the directors and the auditors. The auditors who are responsible for auditing the different processes, the documents, the process, everything, or evaluate the different types of schemes. So shareholders appoint the directors and the auditor to ensure that the entire affair is managed properly. So it focuses on leadership, accountability, transparency, and ethical conduct. So entire gamut of activity are only done with an intention that everyone has an accountability in their leadership. A transparency can be maintained, a fair conduct or ethical conduct can be maintained. Governance is the overall control system of any organization, while corporate governance specially applies on how companies are managed and supervised. So when we talk about governance, suppose India as an economy, India here the president, the prime minister, the different union ministers, these are bodies who have been appointed to govern the entire country. So that is overall governance of a system. Similarly, when we talk about a corporate governance, it applies specifically to a company where the company can be effectively managed and supervised. Now let us discuss briefly what are the principles on which the corporate governance relies. As we had discussed, that it relies on few factors like transparency. So if we have a proper governance, then companies have to follow certain rules and regulations. So first and foremost thing is that there has to be transparency. So company needs to declare or share or announce the accurate and timely information to its shareholders or the public who are the final stakeholders of that company. So as you might have seen that the financial statements are publicly disclosed, timely disclosed, so that the shareholders or investors, they know what is the actual financial state of the company. So there has to be transparency. There should not be any sort of manipulation. Accurate information needs to be displayed or timely informed or announced or declared to the different stakeholders. Now, if the stakeholders get the transparent or proper information at proper time, then they will be in a position to take certain timely decisions so that their performance of the company will not be impacted much. Like for example, if they know that there is a requirement of fund by the company, then they will take a timely decision to for how they are going to procure funds from different sources. So that is why utmost transparency without any sort of manipulation of the company's information should be shared to the different stakeholders. Next principle is the accountability. Now, decision makers who are the top level managers like the CEO, the board, and managers are answerable for their actions. So, the persons uh, who are the decision makers actually are accountable or answerable for any sort of decisions that they are making. So they must protect the interest of the shareholders and the stakeholders. So it should not be a person centric decision, rather a person who is at a functional head or who is the head of the company has to make any decision which he is answerable for. And when he makes the decision, he must ensure that it is at the larger interest of the society, the shareholders, and the stakeholders. So, accountability is one of the aspects of the corporate governance. Next principle is independence. So, every board of directors should function without undue influence. They should not be biased. Every board of directors which is who is appointed should not have a bad track record. He should be a professional in that particular field, and he should not have the mentality of being influenced by others. So that is known as the principle of independence. So these above three principles, there are other principles apart from that. This also, transparency, accountability, and independence. These three principles ensures that a company is run openly, responsibly, and without any influence of any other person's personal interest. Now, moving on to another three principles. First one is security. So, as we had already understood that transparency is very much required when you disclose the details about the organization to your stakeholders. Apart from that, security is also very much essential. Nowadays, people who are there within the organization, they are misusing the data, and they're trying to uh, share the data which are very much confidential data about a company to the other competitors or maybe other beneficiaries. So that is very much important aspect of a corporate governance. So to protect companies data, to protect the trade secrets, the formula within which the company is operating, and the stakeholder information, this builds a confidence among the investors and customers. So safety and security of data is very much important. Next principle is fairness. All stakeholders must be treated equally, and justice may be given. It can be the client of the company who has purchased the insurance policy, or it may be the person who is the agent of the insurance company. So whenever there is any issue arising between these two, so justice should be given properly to each one of them. So that is why a fair approach to all stakeholders must be maintained. There should not be any discrimination between a majority and minority shareholders. And ethics plays a very vital role. It is also linked with the fourth principle, which is security. So company must follow the laws and maintain a strong value system. It should avoid conflicts of interest and promote honest practices. So these are few principles on which the corporate governance should lie upon. And these principles build trust, protect shareholders, and ensure long-term stability of the organization. Now let us move on. We have understood what is governance as a total. It is basically the structure of an organization to operate smoothly. Then we have understood what is meant by the corporate governance and also what are the principles on which the corporate governance lies. Now let us understand the corporate governance from the perspective of insurance sector. So like any other company, even in insurance company also, it is managed by persons who are professionally sound in such type of business. So who have a finance background and they are professional managers. So insurance companies are managed by professional managers under the supervision of board of directors. So top level persons in an insurance companies are the board of directors. Now under the board of directors are the professional managers who are functioning under them, and still under the professional managers there will be few insurance agents who will be operating and dealing with the clients. So this is what there is a structure similar as we see a hierarchical structure in a company. So now the board, who is the top level, is accountable to the shareholders and monitors the company's performance. Now shareholders are in the market, so they are expecting something from the company, insurance company. So now the board of directors are responsible or accountable or answerable to the shareholders of the company because they are the owners of the company. So the board of directors are ultimately responsible for the company's performance also. So that is why selection of board of directors is very much important, that right person is appointed at the right place. So shareholders have the right to appoint the directors. So stakeholders such as policyholders, investors, and regulators have economic interest in the company. So what is the role of corporate governance then? The corporate governance ensures decisions are fair and not biased towards any group. So the governance here is done by the board of directors. They should see that all the decisions which are taken, like suppose there is a claim to be settled, insurance claim to be settled by a policy holder. So now the governance, the system has to be such that it has to be fair, not biased towards any of the group. It should not be biased towards the insurance company. It should not be biased towards the person who is the policyholder or the claimant. So fair decision has to be taken. The corporate governance focuses on long-term stability and financial success. So when you start doing the business properly, when the policies are, the claimants get their claims on time, settled on time, there are no sort of conflict which arises between the claimant as well as the company's person. So gradually the trust will be created in the market about that particular company. So finally there will be a long-term stability, and ultimately when the volume goes up, then there will be financial success for that company. Corporate governance helps insurance companies to operate in ethical and responsible manner. Because insurance companies, what they are doing, they are handling the money of the public. I hope all of you would recall that when it comes to insurance, premiums are collected from different policy holders. So the premium is the money of the public. Now these premium are also invested in different uh, bonds, like government bonds. We have already discussed about this. So it is invested in different types of investment which are safe. But when we are investing that the public money, so obviously a strong governance need to be there, because at the time when it is required to be repaid to the policy holder, the money should be available with you. So it helps, this corporate governance helps the insurance companies to operate in an ethical and responsible manner. And it builds public trust, which is critical in the insurance business. We have just now discussed that whenever there is no conflict, whenever a claimant understands the policies properly, and his claim settlement process is also smooth, his premium payment of the premium, everything is smooth, the system at complete is a smooth process for the policy holder, then gradually it builds a public trust, which is very much important for an insurance company. So insurance companies handle the public money, so that is why a strong governance ensures safety of the money, fairness and trust. Now let us move on to the regulatory framework and the importance and its importance in the insurance sector. We already know that the insurance sector as a whole, the corporate governance in the insurance sector is guided by the Insurance Regulatory and Development Authority of India, IRDAI. IRDAI issued detailed governance guidelines which is applicable to the insurers. Insurers means the company. So all the guidelines or policies are detailed out in the IRDAI. So these work along with the provision of Companies Act 2013. The guidelines includes appointment of CEO, key management persons and auditors and monitoring compliance. So in these guidelines which have been laid down by the Insurance Regulatory and Development Authority of India, in these guidelines they have also mentioned the appointment of the chief executive officer, who is actually the top level management. Then underneath the chief executive officer comes the key management persons, who are the head of the different functional areas of an insurance company. And then underneath the key management persons comes the auditors and the monitoring the compliances. So why strong governance is very critical in case of insurance? As we have already discussed that the insurance companies are handling the money of the public. So for that reason, it is very much vital that a proper strong governance has to be there. And more or less, the insurance agreement is a legal contract. It is a contract between the insurer, the company, insurance company, and the policy holder. So obviously, when there is a legal contract, that means that there is a period which is fixed where you are going to pay a particular amount of premium. There is a date of renewal of the policy. There are different ailments which the policy is covering. Then there is a sum assured which has to be which is paid. So all those things are mentioned in the legal contract. So that is why it becomes very much important that a fair, transparent monitoring is required, so that each and every things which are mentioned in the contract flow in a particular line and there is no ambiguity or confusion when it is finally settled out. It involves risk transfer and protection against the future uncertainties. Higher governance standards increase the confidence of investors and the policy holders. So when there is a strict governance standard which is followed by an insurance company, then the trust of the investors and the policy holders are gradually increasing. And when it gradually increases, obviously the financial performance of the insurance company also will be increased. So strong governance of a insurance company increase the credibility and long-term sustainability of that company. Because insurance deals with people's financial security, strict regulation and strong governance are essential for trust and stability. Now, as here we have understood that it is the IRDAI who prescribes the guidelines for the different authorities who are going to govern the insurance sector. So, what are the purposes of this IRDAI guidelines? The guidelines issued corporate governance, the IRDAI has issued corporate governance guidelines for the insurance companies, which was initially prepared in the year 2009 and it was revised after the Companies Act 2013. It is applicable from the year 2016-17. And as discussed, it aims to strengthen the governance practices, transparency and accountability in the insurance companies. Now, what does the guidelines laid down cover? It covers the appointment and the roles and responsibility of the managing director or the chief executive officer and the different key management persons who are accountable to the CEO or the MD. Laid down policies are there for the appointment of statutory auditors who are there in order to monitor the compliances, and there are clear responsibilities which are laid down for the board of directors and which ensures compliances and regulatory requirements. So IRDAI guidelines create a formal system so insurance companies are managed in a disciplined, transparent and regulated manner. Now let us understand the basic objectives and the governance framework under the IRDAI. Why these guidelines exist? We have already understood that these guidelines are basically existing because it lays down the roles, the responsibilities, accountability of the CEO or the managing director. Then comes the different functional heads. We tell them as key management persons, and then the auditors. So accountability of the board, management and stakeholders. So introduce checks and balance to prevent weak internal control. So the guidelines are existing because there has to be certain laid down policies and procedures so that you can control the entire system. There has to be checks and balances at regular intervals. The audits has to be there at regular intervals so that you can very well take initiatives or take decisions wherever it is required in a particular scheme or about a particular person. It protects the policyholders' interest and ensures financial stability and promotes ethical, prudent and transparent decision making. So major governance elements which are covered are governance structures of the insurance companies. So IRDAI shows what should be the overall structure or hierarchies which has to be there maintained by all the insurance companies. What should be the board of directors role and the chief executive officer's role? What are the functions of key management personnel and the role of the appointed actuary? So appointed actuary is another person which is below the key management personnel, who are the key management personnel are just beyond the board of directors. Then comes the appointed actuary. Actuaries are different functional heads or officers who are appointed for different functions or disciplines. Like someone is a officer who settles the claim. Someone is an officer who evaluates the schemes or proposals which have been given by the proposers. So there are different actuaries who are appointed under the key management personnel. External audits and disclosures, how the external audits have been has to be made and what should be the disclosures which has to be public. Stakeholder relationship management, and whistleblower mechanism and regulatory interactions. So all these major portions are being covered in that IRDAI guideline. And why these things are matter of concern for the financial system? Because a strong governance improves solvency, risk management, and long-term sustainability. This governance enhances trust in insurers and strengthens the overall financial sector stability. IRDAI framework ensures that insurance companies are run responsibly, so policyholders' money are safe and financial system stays stable. This is very much vital point, because when we are talking about insurance company, there are so many companies which are private sector companies, which are not under, which are not public sector companies. So now private sector insurance companies which are also coming under the purview of IRDAI. Now when these companies are floating several schemes in the market and they are collecting the money of the public in terms of premiums, it is their liability that they invest those money in suitable schemes and safer schemes where the money of the policy holders are safe, so that in case the policy holder is anytime claiming the amount as per the policy guidelines, so the insurance company should be in a proper position to repay the claims as it has been laid down in the policy. Now let us understand the governance structures in the insurance companies. These structures are as per the policy, as per the guidelines which is laid down in the IRDAI. So why this governance structure is very much important? It is well understood that it is public money. Things has to be transparent, things have to be secured, and things have to be properly disseminated to the shareholders. So insurance company in India may be listed or unlisted, but both must follow a strong governance law. So as I said, few companies are existing which may not be listed in the stock exchange. So few companies may be purely private, but all the companies which may be listed or not listed, they both must have to follow the strong governance rules which are laid down by IRDAI. The structure is designed to ensure professional management under the board supervision. So board of directors are the ultimate top level who are strategically planning the different types of schemes. So the entire structure or hierarchy has to is designed in such a way so that the board of directors is supervising all the other lower authorities. Companies are encouraged to align with SEBI and Companies Act governance standards for better transparency. So all the insurance companies are encouraged to align their system as per the SEBI guidelines and the Companies Act. Like how many days, like suppose quarterly reporting has to be there. Suppose every file which is being evaluated and accepted for the insurance schemes has to be sent to the board of directors for their approval. So there are different type of governance standards which are laid down by the authorities, by the regulating authorities, which needs to be adhered to by the companies. Even the unlisted insurers should prepare a governance system for future growth and listing. So those companies which are not listed in stock exchange also, they should they are encouraged by in the guidelines, so that they can also, they should prepare their governance system, and finally they should go for listing. Now let us understand what is the composition of board of directors. We are talking that board of directors is actually responsible and accountable for the entire smooth operation of a insurance company. Now, board of directors is accountable or answerable to the stakeholders, to all the shareholders. So now composition of the board of directors also, that is why it plays a very vital role, that who are the persons who are involved in that in the board of directors. So board must include qualified and experienced directors from finance, law, insurance, banking, etc. So they have to be professionals, qualified professionals having experience in related or allied subjects of finance. There has to be, they have can have finance background, they can have law background, insurance and banking, etc. And the size and composition should match the scale and complexity of the business. So now size, like suppose you want to have more number of finance professionals, suppose you want more number of banking professionals, so it depends on the complexity of the business, how big is your business, so that you can have the size of and the composition based on the complexity or the scale of business. How, suppose the business is large enough, so you can have 30 to 40% of the persons as law professionals, or let us say 20% as finance professionals, few 30% as banking professionals. So it depends on how big is your organization and how complex is the different types of schemes which are available. So that is why it depends on the size and composition of the insurance companies. The structure of the board of directors depends upon the magnitude of business and the ambiguity of the different types of policies or products which the insurance company is providing. But there should at least be independent directors who must be included to ensure that there are unbiased decisions. There has to be independent directors, and who are persons not influenced, like there can be one person from the court or judicial line. There can be one person from maybe corporate sector who is not linked with this, like it should not be biased. So such type of personals, independent directors has to be there, who are taking unbiased and uninfluenced decisions. And at least one women director is also required as per the Companies Act 2013. Apart from all this, there has to be one women director who is also required as per the Companies Act 2013. Board members must understand the insurer's product, risks and operation. This is very much important. That is why it is mentioned that all the board members should be qualified and experienced directors, because they need to know that what type of different schemes are being provided by the company, what type of risks are predicted by the type of schemes which are given. Like suppose you are also selling general insurance, you are also selling life insurance. So what aspects of risk are covered, or what aspects of risk do you foresee for when you cover the life insurance? What type of risks do you foresee when you cover the general insurance? So you should be able to predict the risks which are forthcoming or which are in line with the different types of products that are being provided to the policyholders. And the entire operations mean the process of closing the entire loop of right from the agent moving to the client, discussing the policy, then completely the proposer is giving the proposal, and finally closing the policy, and also how the claims are settled. The entire operations should be known by the board members so that they take time, so that they can take timely decisions of whenever required, whenever their interference is required. The governance structures ensures the company is guided by capable and independent leadership that protects the stakeholders' interests. So always the governance structure should be such that the company, because since the board of directors are the persons who are actually taking the decisions, and they are also, it's not only the decisions, they are accountable or answerable to the shareholders or stakeholders. So that is why the entire governance structure should be guided by the capable and independent leadership team. Now, coming to the roles and responsibilities of the board in the insurance companies. So, since they are in the top level and they are completely accountable to the shareholders, so their role becomes more pivotal. They play a visionary role, a strategic policy making role. So, and the day to day basic operational roles or responsibility are of the persons who are underneath them. So, first and foremost responsibility is strategic and policy role. So, they define and periodically review the business strategy, approve the underwriting, retention, and reassurance insurance policies, decide investment policies with proper asset liability management, and set ethical standards and code of conduct. So first of these entire four things, when you see this, these are purely planning and policy making decisions. So what they do, they are defining the periodically review the business strategy. The suppose they have made a strategy that within these next 3 years, they have prepared a plan within next 3 years, the number of policies to be floated in the public has to be x numbers. So they have defined the strategy of getting that x numbers increased, and periodically they will be continuously reviewing whether they are in the right track, how far the people are obtaining their policies or not. So they are defining the long term goal of an organization. They are approving the underwriting, retention, and reinsurance policies also. So when the insurance company will be in a position to underwrite, at what point of time, what should be the limit of underwriting, and in which case there will be reinsurance of the policies. I think all of you have, you know what is the reinsurance companies which are available. So when should they go for the reinsurance also? So the policy has been defined, the operational part is done by the persons who are the key management persons who are just below the board of directors. And as I was just discussing, when you are getting a public money, the public money, you are not only retaining that money, idle money with yourself, you are deploying the money in different government securities so that it is safe, and whenever you want, you can realize the money, sell the assets and realize the money. So they are deciding that in which government bonds the money of the public that is collected has to be invested. So the policies with proper asset liability management is being prepared by them, as well as they also laid down the ethical standards and code of conduct of the entire organization. The second roles and responsibility is the risk compliance and control. So they establish the risk appetite and risk management system. So risk appetite is for the company. Like suppose you are giving a policy which are suppose fire related policies, fire policies. Now you have to assess in that particular locality or in that area what is the magnitude of catching fire of the houses. Or suppose the land is there, crops are there, what is the magnitude that there will be the crops will are actually done with the past histories. So how far the crops are actually damaged by the pests. So you need to establish a appetite of risk to assess whether that much amount of risk can be taken by the insurance companies or not, whether these type of people will be paid, will be given or offered the policy or not. And if that does not happen, if they are not this suppose there is a frequent catching of fire, suppose there is frequent pest uh, destroying the crops, then how far you will be able to uh, pay the money or the claims, how far you will be able to settle the claims to the policyholders. So all those things you need to understand and assess. So each ensure compliance with IRDI and legal regulations, and to monitor major risks and maintain internal controls, and to ensure a proper IT system, data integrity, and business continuity plans. So the entire gamut of activities has to be assessment of risk, compliance of the rules and regulation laid down by IRDI as well as SEBI, and to monitor at different intervals whether the planned activity are proper or not, going in proper line or not, and also maintain the integrity of data, security of data properly. The third function or roles and responsibility is the governance and stakeholder protection. As we know that the board of directors are actually accountable for towards or answerable uh, towards the shareholders. So this ensures fair servicing and grievance redressal for the policyholders. So suppose any policyholder has any sort of issues, then they should be the board of directors are liable to settle their grievances. Work with management but retain final accountability. Use committees for efficiency but not transfer the core responsibility. They can use small committees so that they can efficiently handle the entire operation of the insurance, but the final responsibility is not for the committee members. Committee members are short-term committees which you can uh, frame in order to resolve issues. But ultimate accountability or responsibility is on the board of directors. Focus on long-term sustainability and shareholders' confidence. The board sets direction, manages risk, and ensures compliances and protects policyholders while guiding the companies towards long-term stability. Now let us move on to the control functions. Now, what is this control function and why actually these control functions are required? Insurance companies handle high financial risk, so strong control systems are very much important. As we were just discussing that they need to have a clear guideline where this money had to be invested. The asset liability management needs to be defined properly. Because at times when you are going to repay the money back to the policy holder, at times there has to be liquid money available with the company. Key control mechanisms are systems for identifying, assessing, monitoring, and reducing risks. There has to be processes to ensure the compliance with laws and board approved policies. The internal controls has to be there to check whether the risks and compliances policies are followed. An effective internal audit function to review performance and report gaps, and independence of control functions should, such as risk management for daily operations. So control mechanisms are set so that the long-term vision or goal of the organization are not affected. So when you go on daily monitoring and assessing the day-to-day operations, you are going to reduce the risk. Suppose there are quarterly compliances as per the board approved policies, then that is a check and balance measure. So there you will see whether there is any loophole or whether any default are there or whether any issues are there, then you can take any corrective action. So there has to be internal audit team which will functions to comply with the gaps if there any while reporting any quarterly review. The board oversees all the control functions. For group insurance, group-wise risk control system must also be implemented. The control functions act like the company's safety system, which detects the risks early and ensures the rules are followed. Now, delegation functions of the board committee. Why delegation of functions are? Because it's not that the broad board committees or the board of directors can functions isolatedly. So they have to have similar small other committees which have to work, but accountability and responsibility is for the board. The board cannot handle all the operational details. So committees are created to focus on specific governance areas while the board retains final responsibility. So accountability and responsibility of the board is final, but yes, they can have few committees which are which will help them for smooth operations. Like some mandatory committees are audit committees. Now only I had told that an internal audit committee has to be there, and interim audits has to be made so that it is a control system to see that whether everything is moving on smoothly or not. So you have to see all the policies have been documented properly. All the policy holders have given all their different documents as required by the or as mentioned by the policy. So every check and balance has to be there in every part. The audit committee ensures transparency and reliability of the financial statements. Another mandatory committee is the investment committee. We were talking about asset liability management. Now, committee will recommend the board of directors that such type of government schemes or bonds are available which are safer and where we can invest the policyholders fund. So that is a group of investment committee who are experts in their own field to decide on what type of uh, government bonds or investment patterns are available. Another mandatory committee is the risk management committee, which develops the risk management framework and sets the risk limits and review risk return performance. So risk management committee studies the entire policy documents or schemes which you are going to float to the different stakeholders. Now, when it may be fire, it may be health, it may be life insurance policy, or it may be general insurance policy. Any type of insurance policies, when it is floated, has to be judged or first assessed by the risk management committee to see what should be the sum assured, because how much the sum assured you can provide to the policy holder, and up till how much you can take the risk, and ultimately how are you going to review the return performance. Other possible committees which may be there, these are not mandatory committees, but depending on the functional heads, you can have nomination or remuneration committee, policyholder protection committee, CSR committee, ethics committee, and asset liability management committee. We have already discussed that there are key management persons and appointed actuaries. Key management persons are just below the appointed, just below the management, the CEO level. The CEO, MD, whole-time director manages daily operations of the insurance company. So these are key persons, the top level. Appointment, reappointment, or removal requires approval of IRDAI. So they have to be approved. Their appointment is by IRDAI. They must follow the broad directions and act in the policyholder's interest. The authority must be informed if the CEO resigns, and companies also should have succession planning. Now, appointment, the role of appointed actuary is they must follow IRDAI regulation, and they must meet fit and proper as per the eligibility criteria. Duties of auditors and disclosure requirements we have already discussed in the previous slides. Outsourcing arrangements means, suppose the insurance companies want some support services to outside agencies like call centers, IT services, document processing, then they can outsource the agencies from outside. Like even data is treated as, it is more important that data is treated as a gold. Even if an external agency handles it, ownership stays with the insurers. So data must be secretly and properly kept. The core insurance functions like underwriting decisions or key policyholder obligations, generally these type of functions cannot be outsourced. But yes, when you are calling marketing purpose, the persons can be outsourced. There is another policy known as whistleblower policy, which actually keeps a check and balance. Every organization has blind spots. Some issues will be there in every organization. So problems often appear first at the ground level, where employees sees them before the leadership does. So a whistleblower policy creates a safe internal alarm system. So employees can report issues like fraud. They can issue, they can also go before the leadership team if they see fraud, misreporting of the finances, governance failures, or ethical misconduct. They can report confidentially regarding this, any of the issues, usually to the chairman or a board member. And they can bypass, if anything they can see, they can bypass the middle management and directly go to the top management. So this is, that is why the name is given whistleblower policy. Three pillars that makes this system very credible, this whistleblower policy, is awareness. Employee must know that such type of policy is existing and how they are going to use it in case of any sort of exigencies or any sort of fraud or misreporting they see. It should be confidential in handling because they are reporting it independently to the higher level, so it has to be investigated independently. And anti-retaliation, the person reporting is protected from punishment. So these are the three pillars on which this whistleblower policy revolves. Without protection, no one will speak up. Silence is favorite habitat of corporate scandal. So everyone should know that they will be protected if they are reporting such type of activities to the higher authority. There's also a regulatory safety net. If the appointed actuary or auditors detect major non-compliance affecting financial health, they must inform IRDAI. This allows the regulator to step in before the policyholders suffer. Whistleblower systems convert the hidden risk into visible signals early, because when they are working in ground level, it actually, the fault actually comes to their eye initially. So that has to be escalated to the higher authority. Whereas when it goes to the leaders, it takes time. So while working in the floor, if they see any sort of fraud activities, they can escalate it to the higher authority. This is all about the unit 12. Thank you.